Ever wonder why some businesses thrive while others struggle to stay afloat? It often comes down to small business owners understanding one critical factor: revenue. Today, we're diving deep into this crucial topic with Pathway Business Advisor, Key Dawson, and Bob Lancaster, Director of Business Advisory Services, who know exactly what small business owners need to look out for when it comes to tracking and managing their revenue.
So Bob, debt service coverage ratio, how do you get to that number?
Well, the way it's calculated is you can start out with net income of a company, you can start out with operating income, whichever you want to do. But let's start with net income. That's a simple thing. You add back taxes, you add back interest expense, and you add back depreciation or any other non-cash expense you have in your income statement. And that creates a term called EBITDA, earnings before interest, taxes, depreciation, and amortization. In theory, that's a proxy for the operating cash flow of a business. That's your numerator, EBITDA or operating cash flow. Divide that by your total debt payments that you have, which would be any kind of debt you have with a bank. It'll include credit cards. If you have debt with third parties or non-financial institutions, so all your debt payments are added up for a year. You divide those into the first operating income number you've calculated, and that's your debt service coverage. It's expressed as a ratio. Greater than 1 to 1 means you have cushion left over. You can cover your service plus some.
So is that super important for an underwriter?
Well, absolutely. I mean, that's how they will calculate. Generally, they get to the bottom line. That is the bottom line. They'll calculate debt service coverage. And based on all the numbers that they've been given, will this debt work? Because they're going to take not only the existing debt, but they're going to add on the debt that you're asking to borrow. And then see whether or not your earnings will cover that as well.
And is it important for a small business owner to calculate that prior to reaching out to a financial
Absolutely.
institution? Yeah.
They should understand that's what the underwriter is going to require and should do the calculation and should be prepared to explain why that's going to be adequate.
So they need to kind of re-engineer before they even
What
make
are
that
you
request.
going to do to get this ratio higher?
Yep.
And logically, you're going to use the money that you're going to borrow from the institution to grow the business and grow the cash flow. And that's the theory.
So with calculating the debt service coverage ratio, what's the major takeaway do you feel like a business owner should know?
Well, I think they should know that the lender is going to look at that ratio. They're going to look at your ability to pay back the loan you're asking for. So you should be prepared when you go to sit down with them to answer the questions they're going to have. So you should do the calculation in advance and be prepared to explain why that number is going to get better over time.
Yeah. So if the margin is tight, you need to have a plan.
A plan to make it less tight.
Yes.
If you're looking to dive deeper into managing your business finances or are preparing your business to receive capital, we've got more resources waiting for you online. Just click the link in the description below to explore topics like revenue management and other crucial metrics that financial institutions consider when you're seeking capital to grow your business. Our team of business advisors offers free support to Tennessee entrepreneurs in various aspects of growing their small businesses and taking on new opportunities. As the largest non-depository community development financial institution in the state, we provide lending solutions and educational services to help grow and preserve small businesses. So join us online and plan your next steps with Pathway.